If you want to understand 2026, don't start with headlines. Start with 5 charts. Because these 5 tell you where growth, inflation, and risk are really going. Markets in 2026 are balancing 3 forces at once: sticky inflation versus easing inflation, slowing growth versus resilient demand, and higher rates versus rising leverage. And small changes in the data will move everything: stocks, bonds, currencies, and credit. So in the next 5 minutes, we're counting down the top 5 charts that explain 2026, ranked from 5 to 1. Each chart answers one question. Is inflation truly cooling? Is the job market cracking? Are financial conditions easing or tightening? Are corporate profits holding up? And is credit quietly flashing stress? Let's get started with number 5 and see if you can guess all 5. Number 5. Earnings. In 2026, the market narrative can change fast, but earnings are where stories meet reality. This chart should show 3 lines: forward earnings estimates, profit margins, and earnings revisions, up versus down. Here's what to watch. If estimates keep rising while margins stay stable, risk assets can hold up. But if revisions roll over, the market usually follows. And pay attention to, if only a small group of mega caps are delivering, that's fragile. If earnings improve across sectors, that's durable. Number 4, unemployment. Unemployment moves slowly until it doesn't. This is the chart that tells you whether the economy is bending or breaking. Use a clean view, the unemployment rate plus one leading overlay like job openings, hiring rates, or initial claims. In 2026, the key is direction, not level. A small, steady rise can signal cooling. A fast rise signals recession risk. And watch participation and wage growth alongside it. If unemployment rises while wage pressure stays high, inflation can stay sticky. If unemployment rises and wage growth cools, inflation typically follows down. Number 3, inflation. In 2026, inflation is less about one CPI print and more about composition. Your chart should separate headline inflation, core inflation, and services inflation. Because services is where persistence lives: rents, healthcare, insurance, labor-heavy categories. What matters most for markets is the trend: 3-month and 6-month annualized rates. If those cool consistently, central banks can ease with confidence. If they re-accelerate, the rate path changes quickly. This chart is the base layer for everything else. Number 2, yields. In 2026, the cost of capital is the game, because yields set the discount rate for stocks, real estate, and private markets. This chart should show the 2-year yield, the 10-year yield, and a simple yield curve view, the spread between them. Here's the signal. When short yields fall, it often means the market expects easing. When long yields rise, it often means inflation risk, deficits, or term premium. And the curve matters because it impacts banks, lending, and liquidity. A curve that steepens because growth is improving is healthy. A curve that steepens because inflation risk is rising is different, and usually more volatile. Number 1, credit spreads. If you only watch one chart in 2026, watch this. Because credit is the first market to price stress, before equities admit it. Your chart should show investment-grade spreads, high-yield spreads, and ideally one simple marker of refinancing pressure. When spreads tighten, it signals confidence, liquidity, and risk appetite. When spreads widen, it signals default risk, weaker earnings quality, and tighter lending. And here's the key 2026 insight. A lot of the economy runs on refinancing cycles. If spreads stay calm, companies can roll debt and keep investing. If spreads widen sharply, spending slows, and everything reprices. This is why credit is the market's truth serum. These 5 charts don't predict 2026. They explain it in real time. Inflation tells you the policy path. Unemployment tells you the growth risk. Yields tell you the price of capital. Earnings tell you what's real. And credit spreads tell you when stress is spreading.
So here's the question. Which chart do you think will matter most in 2026? And what's the one signal you're watching for a turning point? Let me know in the comments.